Good morning, good afternoon, and good evening to the rest of you. Welcome to another episode of Bitcoin Magazine Live. I'm your host, Q, coming to you yet again from my mother's basement, and I'm joined by my co host, P. How goes it, P?
It goes fantastically as always. And yeah, I'm excited for this conversation. Let's dive in.
We got a jam packed episode today in store. We're going to kick things off with our BM Pro segment, and we are joined by special guests from ARK Invest. And then after that, we'll be having an interview with Seed Signer, and then, of course, news and notes with your favorite trio. But let's kick things off with the BM Pro team. Dylan LeClair and Sam Rule have joined us, and we have none other than David Puell, head of on-chain research at ARK Invest, and Frank Downing, handling crypto on-chain analysis as well. Gentlemen, how are we all doing today?
It's great. I'm excited to chat. It's certainly a lot of stuff has gone down in the last 2 months. So, our job as analysts, kind of detectives of what's happening, has been exciting, to say the least, while, half the industry has imploded, but not something we can control. But yeah, excited to break it down with these guys.
Well, let's kick things off there because there was very big news this morning that Dylan, I think you've been at the forefront of covering. Yet another company getting caught up in this contagion, and this time it's Voyager now filing for Chapter 11 bankruptcy. I open the floor to anyone to just maybe touch on what led to this point and what the fallouts may look like going forward.
Yeah, I'm happy to kick it off, but it's great to be here. We've been watching this space over at ARK for some time as the events have unfolded over the past 2 months, kind of leading up to this point. And it's kind of all a series of dominoes that have kind of fell one after another, starting with the collapse of Terra back in the beginning of May. It's something that we were watching really closely, kind of this algo stablecoin concept that proved to totally fail and unwound like $60 billion of market cap over just a few days. That seemed like it was relatively isolated at the time, in that 70% of that UST stablecoin was just in the Anchor lending protocol. This false pretense of 20% stable yield. So it was a coin that really just existed to yield farm. But what we kind of soon learned is there are other, notable parties in the crypto space that were kind of tangled up in that giant yield scheme, namely Celsius and Three Arrows Capital. Celsius exposure through liquid staked ETH that they were using as collateral on the platform, and Three Arrows as investors in Terra, and notable party who came to their defense as the peg was unwinding. Those two parties also have been brought to their knees. You saw Celsius pause withdrawals, most of that because their DeFi holdings were public on chain, and we could see exactly how much liquid ETH and wrapped Bitcoin they had and how much was borrowed against it. And Three Arrows, being a party that had tried to defend Terra, we learned had borrowed from pretty much everybody under the sun, in some cases collateralized borrowing from BlockFi or Genesis where their positions were liquidated. In other cases, because of their reputation and name brand in the space, borrowed uncollateralized from parties like Voyager, $650 million uncollateralized loan that now that these trades have gone against them, they're going bankrupt, and so is Voyager along with them.
It seems like it's a never-ending contagion spiral. We've seen so many of these companies, and I know, Dylan, you've spent a lot of time, and last week you and Sam released the monthly report highlighting a lot of this contagion, and actually, specifically, we're talking about Voyager possibly being the next domino to fall. Sorry, man, the long weekend really got to me, guys. How are you guys feeling about this bankruptcy? A little bit validating, I'm sure, but also, is this a cause for maybe some more concern? I'm going to throw out some price action thoughts here for a second. Do you expect some more downside as the result of something like this?
From the Voyager event, not really. It was obvious to me once we started to see this contagion really take hold in mid-June. I started going through, and not many of these entities are public. Like Celsius doesn't publish, their balance sheet or income statements or anything. But of the few that did, Voyager was one of them, and it was you could see that they actually had $350 million of exposure to a Singapore-based entity. So it was like speculation, but to me, I kind of have an ongoing thread where I just post some updates to all this craziness. But it was, hey, Three Arrows Capital's insolvent, and if these guys are on the hook for 350 million at the same time that their shares are down 33% in 2 days, maybe something under the surface is wrong. And not sure about the exact numbers of their balance sheet right now off the top of my head, but basically all of their customers' assets, like it was like a fractional reserve bank that took a huge impairment loss. Like they didn't actually have any equity capital to cushion the massive default that they took on an unsecured loan. Like that's the craziest part about it, is they were lending customer funds out unsecured to hedge funds that they thought were industry titans and were money good plus an interest rate. And the reality was they weren't money good, and they completely rugged Voyager. And really the sad thing is Voyager's customers' deposits, any equity cushion that Voyager had or had grown over the bull market, completely evaporated in an instant. And so that's why when SBF came out, it was like, hey, we're extending a credit line. It was just like, okay, this seems like a nothing burger, because what is the point of lending to an insolvent business? If the business is insolvent, there's no way that they can lend. And once, Voyager opens up deposits, all the money's going to run. So that was just like, for me, not just trying to pick on Voyager here. It's obviously a lot of companies are tangled in this mess, but a huge loss it's irrecoverable, and it's really sad that a lot of people are going to lose their assets. It's why I've been, very outspoken about it. I'm not trying to hurt any business or any person, but that's just the reality of these type of things.
Just a gentle reminder before I let the rest of our panelists discuss, but nothing discussed here should be viewed as or considered financial advice. Everyone must do their own due diligence. If you're listening to a bunch of people, talking heads online, and make financial decisions off of that, sir, madam, you are absolutely batshit crazy. I do want to ask David, what with all of this contagion that we've all been seeing around the markets, how is this sort of transpiring or being reflected on the on-chain analysis that you're seeing? Are there any metrics in particular that you're paying closer attention to now, especially in the midst of this bear market?
So of course we got capitulation. In terms of on-chain, you can review several metrics on a historical basis. Famous examples of that: MVRV, percentage supply and profit, stuff like that. They are getting to historical levels of absolute capitulation. To give you context, historically, the percentage supply and profit of Bitcoin should be about 45% at loss. We hit 50% or so. So, but still, we are below realized gap and the very reliable so far 200-week moving average. That has happened only like 4 times, I believe, in the history of Bitcoin. For the 3rd time, we penetrated realized gap and every single major cost basis, long-term holders, short-term holders in the market. Within that, this suggests that it could imply an accumulation range, let's say between 16, 20, something like that. But in terms of precision, especially given the uncertainty of the contagion in the crypto markets, that is, you're seeing smaller and smaller entities collapse, which is a good sign. But most worrisome could be the macro uncertainty, especially as Bitcoin has picked up in its correlation since COVID with equities and the broad market. So we're keeping an eye on that. In terms of accuracy, historically, the zone being under the cost base of the market, it has been historically a good accumulation area. But given the market uncertainty, we're keeping an eye on that and balancing those two, confronting views at the moment.
So, David, you have not been subject to my favorite question. Sam and Dylan, I can already hear you snickering over this, but what are your thoughts on just the general correlation we saw leading into the correlation with the NASDAQ and Bitcoin price leading into this downturn? And do you expect this correlation to have broken at any point in this near term or short term?
That's actually a great question in the sense that we believe there's a major dislocation in the market in terms of pricing things in general. To give you the context, in ARK, right, we hold from genomics to Bitcoin. Seeing that divergence, like why should a price of a biotech company should be correlated with Bitcoin at any given time, given their completely different value propositions? So that correlation in the broader markets, let alone Bitcoin, just signifies to us a major disequilibrium in the market and inefficiencies in pricing and valuing things. On the context on when the decoupling could be expected, that's hard to do because one, since COVID, we've had a major inflow of institutional participants, which and those participants have take lead in the price discovery on centralized exchanges, etc. For Bitcoin and therefore in a correlative manner the whole crypto ecosystem. So within that regime, it's hard to guess when the correlation is going to stop because it has unfolded both in a bullish primary trend and a bearish primary trend. Regardless of that, I do think a best way to look at Bitcoin is a debasement hedge as opposed to an inflationary hedge, which I think is part of the narrative. James from Glassnode discussed this privately with me, and I tend to agree with that. I think once the market stops valuing assets as on a per market cap or liquidity or float basis and return to a fundamental appreciation of things, we should see a decorrelation between Bitcoin and equities and through the diversification in the equities ecosystem as well.
I love that. Very hopeful and optimistic, and we will see as time plays out if this decoupling does take effect. Sam, I would love to just give you the opportunity now to share your general thoughts. We've talked a lot of things, and I will let you sort of discuss any of the points that we've discussed that resonated well with you.
Yeah, certainly. I'll bounce around a little bit here. So I'd be curious too what other people found through the contagion. We've talked about it the last couple of weeks, but curious what people have found kind of the most shocking or most interesting part of it that they didn't know before. On the Voyager side of things, I don't mean to index on Voyager, but it seems like it's just kind of company topic of the day. For them, it's just kind of the massive amount of unsecured lending that was in the system, not just across Voyager, but across everywhere else, where as we've seen that now they're going through bankruptcy. BlockFi seems like one of the lending shops that might survive here with the injection from FTX, and they even had a loan to value ratio of 3 hours capital and 75%. So pretty shocking just to see the amount of unsecured lending rolling out here. General thoughts is that of those forced liquidations, those are probably the worst have happened, going down to that 17,000 range. It's interesting that the CME futures on that weekend as well didn't even really budge in kind of the other side of the market to reflect that, which also would tell me another signal with on-chain kind of capitulation indicators that probably have further to go there, as maybe some of that drawdown pain is not realized in the full extent of the market. But I'd be curious to hear, everyone else's thoughts too on if they think kind of the worst is over here from the contagion side. I mean, I can say from the macro side, Dylan and I have talked at length about being, pretty bearish since over the last few months, and then doing some of these spaces and being bearish sometimes is not fun, but almost see that Bitcoin, whether you look at it from an equities correlation standpoint or just from an economic cycle standpoint, it all becomes one trade. And as David mentioned, it gets certainly the value gets removed from its fundamentals. So right now, when some of the stuff looking at is kind of the latest trends in PMI data and kind of leading index for that, looking at some of the bear market kind of cycle rallies, comparisons of where equities are, looking at kind of earnings and PE ratios, kind of turning over in the traditional space. So it's hard to tell, with that liquidation move with Bitcoin, that's kind of like a 15% move from 20,000, where kind of CME futures didn't move at all. And you have equities at large, you can take the S&P down 22% for now. And thinking that, okay, my more base case is that those have more 30 to 40% range to go, kind of peak to trough, to trough to peak. So thinking that Bitcoin is probably going to hold up those relationships over time. I'm still pretty bearish overall in the market. I'm still pretty bearish in the sense that we haven't seen the full extent of kind of like the liquidity and the insolvency issues that are going to float on the surface, probably seeing the majority of them. But I mean, just now we're seeing Voyager go through bankruptcy. So it's almost like every day we're seeing a new company or a new shop kind of announce something that just doesn't bode well for the space. So it seems like we've got more cleansing to do on that front.
Just to chime in on the contagion and what's kind of surprised us, I would say, like Celsius having to pause withdrawals wasn't a surprise, partially because we could see all of their balances on chain. And I think on chain in general is something that's given us a lot of confidence and conviction as we've dove deeper into the space over the past few years. What surprised us was the leverage buildup off chain that you can't see, that uncollateralized lending. Three Arrows Capital in particular was a surprise. And I think, some of those details about, how they were managing funds. For example, they would manage the treasuries of portfolio companies that they invested in. So they write a $10 million check, and that to a new protocol, and that protocol turns around and gives them that $10 million back to manage while they're not using it. And so if Three Arrows goes insolvent with that fund, now you have a protocol that's lost part of their treasury. And that was kind of this hidden management that they were doing that we couldn't see. And those are kind of the more scarier thing is what's happening off chain in this kind of centralized market that you can't see and don't have transparency into. And then on just kind of, Bitcoin versus equities and where the market could bottom. I think one thing that gives us, it's impossible to say whether we've really hit a bottom or not. And I think given the macro headwinds, it's safe to say that there's probably more to go, given that, the crypto market cap's already down 70% from all-time highs. It's possible that, if we're heading into recession and the broader market definitely sells down more, I don't think crypto is going to be immune to that. It may bottom quicker, and if it bottoms quicker, then it may lead the rally on the other side.
We've seen, with the correlation with Bitcoin in the markets, we've seen sort of this forward trading aspect of Bitcoin. I myself have taken full advantage of this, but we have never seen Bitcoin trade or alive, quite frankly, in a macro environment that saw a recession. We are weeks away from what I believe will be the second quarter of a negative GDP reading, which will trigger a technical recession in the broader markets. What impact does this have on Bitcoin in particular as the larger economy has to deal with a recession? Dylan, I'll start with you, and then David.
Yeah, I think that we are, and since basically the early Q1, some really, really smart macro investors figured it out in November when inflation continued to accelerate, and bond yields were still less than 1%, and some of the guys just started to short everything, realizing that a deleveraging event was necessary, and the biggest money that you can make in financial markets, at least in the current paradigm, is off of central bank policy error. And it was pretty clear to those investors, and increasingly clear to us in Q1, that the policy error was made by the effect of far too much liquidity that began to, because of structural issues in, say, commodity markets and energy markets, began to spill over into the real economy with CPI inflation, and the two kind of decade trend of disinflation, low CPI was reversing in a big way. So they started to raise rates, but it's not just the Fed raising rates. It was the Treasury market started to do it for the Fed, and yields started to soar. And it became clear to us that a liquidity or deleveraging event was starting to be in the works. And so structurally, the global system can't sustain periods of high interest rates with the current paradigm. It'll ultimately collapse. That's just the reality of our massive debt burdens at a fiscal level, at a federal level, at a global level, and especially emerging market currencies will collapse as the dollar continues to bid, and there's so much dollar-denominated debt out there. But I think in a Bitcoin specific sense, despite all of the deleveraging, despite all of the contagion, some pretty decent miner capitulation. I expect more, but like the third biggest public miner in the U.S. sells 80% of their stack. Like that's significant. I just don't think we've had that correlation to one kind of mass deleveraging that would basically convince the Fed to come in and actually pivot. And it's like, okay, not all analysis is based on the Fed, but we're in this dollar system where it's almost everything is one trade, and it sounds too overcomplicated, but this is basically it. It's everything's either short volatility or long volatility. And being long volatility has a huge asymmetric payoff because most every asset on the planet is short volatility. Short volatility is just your long credit expansion in the fiat system. And so I kind of believe that we're still with an global economic slowdown, with commodity prices which have come down but are still very high, and just the world economy kind of just being put into a tailspin. Real economic productivity is not down. Nominal is up. Rather, I'm sorry, twisted those words around. I still think we just need that final flush out. We've seen Bitcoin get pummeled, but it's Bitcoin is essentially a short dollar, right? And the dollar is strengthening with intensity now, and so that's why I kind of hold off in saying this is the generational bottom, even though from every metric we look at, Bitcoin is extremely undervalued and is below cost basis. All this stuff, it's a great buying opportunity. It just might get a lot better because we're seeing these macro conditions just continue to deteriorate. So that was my long-winded answer. Sorry for not being concise.
Never apologize when you're sharing your thoughts with everyone, Dylan, please. David, I present the same question to you. What effect does a broader recession in the broader economy have on Bitcoin?
Pretty much in line with Dylan. That's if you look at a broader analysis of Bitcoin as a whole, take the on-chain factors, the unwinding of the crypto contagion correlations to crypto only. The most worrisome part is still the macro environment. A few counterparts to that, like we have major signs of the hawkish Fed, their dot plot projections are also in the 3.8%. In the 38 basis points, stuff like that. On top of that, we are seeing a huge increase in credit default swaps. So as per CDX, that rose, I think, twice in September. Also a worrisome factor. The yield curve flat, all that. Conversely, looking at gold as a leading indicator of sustained inflation, and copper on top of that as a lead on gold. We haven't noticed, gold has been flat for about 2 years. Copper just taking a downturn in the commodities market. So that gives a little bit of pause in this whole context of how, yes, the recession is coming, but you should look for peak inflation, in my view, in terms of defining a macro bottom, which includes equities and Bitcoin. Historically, equities bottom a month prior to peak inflation. So we're keeping an eye for that. There's a few signs, although inflation is of course not transitory. There's a few signs of how the now hawkish Fed and its rising rates may affect a lowering of the macro environment in terms of inflation. So we're looking for that interest rate recovery, but still very much wary of the macro environment.
David, you brought up something that Dylan, you actually sent a tweet out earlier today. Chris, if you could pull that up, just showing that the credit default swaps for Credit Suisse are reaching levels that we haven't seen since the great financial crisis. Can you walk us through just what does this actually mean? Like, what are these credit swaps? Why do people need to care or be concerned about this price movement?
Yeah, I mean, I'm not a bank analyst. I don't have a Bloomberg terminal. I saw it on Twitter and credited Lawrence Lepard with the chart. So I don't look at bank credit default swaps to trade Bitcoin. But I think it's more so just telling about the direction everything is going. More counterparty risk, more contagion, not just in crypto markets, but in general, more debt defaults. Like people need to understand that fiat money is created through lending. It's destroyed through debt defaults. So what's happening with the crypto exchange rates, like money, dollar denominated promises, IOUs, assets that people thought they had on their balance sheets weren't assets when other counterparties defaulted. That's kind of the story of the great financial crisis, and that's the story of just like kind of recessions in general. It's a period of credit. It's a deceleration at first. It's a deceleration of credit expansion, which if it worsens enough and there's too much that much debt out there and enough defaults, it turns into not a deceleration of credit expansion, but a credit contraction. And that's when asset values fall, and that's when volatility increases and liquidity decreases. So yeah, I mean, I think just if you look at a lot of the bank CDSs, they're going up to COVID 2020 highs, and that's just not a healthy sign. It's just there's trouble under the surface.
We talk a lot about volatility. Dylan, you have brought up the importance of the VIX throughout our numerous conversations. One thing that I did read over the weekend, from the only thing that I read over the weekend, was just the fact that the VIX actually is, while trading higher, still hasn't reached anywhere close to levels we saw during COVID or even during the great financial crisis. In your opinion, does this imply more volatility, which could very well be upside or downside?
Yeah, I mean, I'm not an options trader for equity markets, so I'm not actively trading all this, but I think it's a really just important signal for investors to understand risk on, risk off, what a high VIX means, what it means for options pricing, what it means for just like not even just sentiment, but just like kind of the overall market liquidity. So I think VIX certainly goes higher. Whether it goes lower in the intermediate term is another story. But I'm looking at Move, which is the credit market equivalent to the VIX, U.S. Bond market volatility, and that since early spring has just been through the roof. So the most liquid markets in the world are trading like it's the COVID 2020 pandemic crash. There's some trouble, and I think that's probably indicating where the VIX is probably going in the next 6 to 9 months until some sort of reaction function from the Federal Reserve, and that's higher.
Frank, Sam, I want to give each of you the opportunity to also share or discuss just what we've been talking about here regarding the, in my opinion, impending recession, Bitcoin, and just the general volatility in the markets. Frank, we can start with you.
Yeah, I mean, this is something we talk about all the time. We were just talking about this today. I mean, it's pretty crazy to see, managers that are looking at their portfolio. It's not just crypto that's down anymore, right? Their bond portfolio is now bleeding, which is pretty crazy. And we're talking about markets that are much bigger than the crypto markets. If you look at housing, which does not look like there's any good signs ahead. Or the auto market, for example. This is trillions of dollars of paper out there that all looks to be potentially in trouble. And so from the macro perspective, I think increasing volatility should probably be expected.
Yeah, I would just add to that, I think it's all been about when I'm looking for like a Bitcoin bottom, kind of in the cycle, you can look at a lot of the on-chain cyclical indicators. You can look at a lot of price mean reversion tools and say, okay, we have these huge value, Bitcoin's way out from fundamentals here. Is it a good time to allocate? Which might be a good question in terms of what David and Frank think of like allocating now versus allocating over the long term, kind of accumulating when you see these kind of like fundamental value shifts, but also that the legacy market hasn't really necessarily put in a bottom. Dylan and I have been talking about it for a while to see something like credit spreads blow out. So obviously CDS is one way to look at that, just credit spreads of like high yield corporate debt, which is probably the most likely at risk in the Western world, or emerging market debt relative to maybe like 10-year treasury rate is also a good way to look at those blowing out, which they haven't yet, but they've been rising and accelerating. If you look at like the Goldman financial kind of tightening index or index overall for financial conditions, it essentially says like the whole system right now, although we've seen these massive moves in rates, financial conditions are still relatively pretty loose, kind of indicating that we can go a little bit further. But that rate of change in those rates, I think we've yet to see a lot of those problems play out, maybe on the earnings side of things for businesses as we're starting to have a much higher cost of capital out there as well. So, you know, for me, there's just a lot more on the bear side of things to point to that, you know, we're just in the beginning innings of this starting to turn over the next 6 months. And to David's point, you know, one of the indications of like when we say, okay, when is really Bitcoin going to be that kind of turnaround asset again, or have that like high end flow of demand? It really comes down to maybe the best narrative that it's a debasement hedge. And then, you know, you're looking at when is the period of kind of monetary and fiscal stimulus that's going to come back into the market that's kind of needed to kind of rescue the system, the loaded debt system that we've talked about over here. So I think that's really maybe more of the pivot turning point in the short term, whether that's 6 months from now, you know, 6 months to a year, maybe that gets accelerated. But that's in my mind, maybe what I'm looking for. First, like an equities capitulation bottom in the macro environment we find ourselves in today, kind of a deeper recession playing out. And then, you know, more of a turning point where there's no other solution other than to increase monetary and fiscal policy.
Yeah, I think just from the timing perspective, I mean, if you look at just a case study of one on-chain indicator, MVRV crossed below 1 on June 13th when Celsius paused withdrawals. And historically, outside of COVID, which was, you know, obvious an extreme, you know, V-shaped recovery, MVRV crossing back above 1 has been a 5 to 10 month long process. And so, you know, you can't look at one indicator and call the bottom. Probably more likely a place you could dollar cost average, but not a place you'd want to kind of go all in on, given that there's commonly more pain ahead before it ultimately reclaims 1.
All right. I'm going to ask a question that I know everyone on this panel hates to be asked, and I will preface and tee it up saying, if you actually knew the answer to this question, none of you would be here. You would own your own island and have some sort of a crystal ball. So yes, I know that you don't know the answer to this question. Just entertain me for a moment, please. In your opinion, what would be the type of event that was going to cause the Fed to switch its stance? Dylan, we'll start with you, David, Sam, and then Frank.
Year-over-year deflation. I think they can induce a lot more pain for a lot longer. And also probably the first kind of like pivot would come in the form of some sort of kind of monetization facility for federal debt. And you know, that's if the consumer's hurting and they want to do some form of economic aid. I don't really have a timeline for that. And that's honestly not I'm not you know, hoping for a Fed pivot tomorrow. And honestly, I kind of have an alternative and maybe a little bit more bearish, not thesis, but just potential outcome or path that Bitcoin and the, you know, broader crypto market takes over the next couple of years. And I think it's analogous to the .com bubble, where, you know, and it's obviously an example that's been told time and time again, but just if you dig into the similarities, you have this emergent thing. Our thesis is it's Bitcoin. If you want to entertain the idea that crypto and blockchain more broadly is the big innovation here, and Bitcoin's just at the center of it, that's fine. We won't debate over semantics. Nevertheless, if you're a believer in it, in one of those two paths, the thesis is not going away. And so you have this explosion in interest in internet.com, stocks. Everybody knows, or at least the smartest people in the room know it's the future, but it gets, way overhyped, way too speculative, way too much fraud. Let's highlight the fact that there's a lot of the fraud occurred here had punished the exchange rate, right? Over double pledging collateral, lying about balance sheets, total assets, from Three Arrows Capital, especially. Like that's, as some people have been like, hey man, you better watch what you say on the internet. No, it's fraud. And Three Arrows has bigger fish to fry. Their legal team. But I think just, wiping away all of that, when the Fed did pivot, and the housing market was the thing that got reinflated, and tech stocks didn't V-shape bounce to infinity overnight. It was a 20-year parabolic ascent, undoubtedly. But Amazon, the survivors of the tech boom, rose from the ashes. They didn't bounce right away with the Fed recovery. So I think we all understand Bitcoin's here. Bitcoin's really important. It's going to serve a factor of 100 times more importance in the future if the broader Bitcoin thesis is correct, which I believe it is. But it may not be like the COVID V-shaped recovery, straight to all-time highs, straight to 100K, straight to 500K. There's a lot of risk managers out there. There's a lot of institutions, that are watching this entire, for better or worse, lack of a better term, shit show, and saying, I'm not touching this space with a 10-foot pole. Once there's some regulatory clarity, once there's, et cetera, then I'll allocate some. And obviously that doesn't stop the pleb from buying any Bitcoin. That doesn't stop someone that's seeking monetary freedom to buy Bitcoin. But like the big capital allocators, the guys that are sitting on huge fixed income portfolios, et cetera, they're not rushing in to go buy Bitcoin at 19K. Like they're going to dip their toes in the water eventually, but it's going to take some time, and it's going to take some, more regulatory clarity. Like I'm not a big fan of regulation, but that's just the reality of the big money. And so if a Fed pivot comes, but not if, when it comes, say it's 2023, whenever that is, Bitcoin will bounce, and I think it'll bounce directly on the news, but it's, that's more of just a kind of an intraday trade or, narrative shift. I just don't think it potentially doesn't V rocket to new highs as everybody understands the end game. It's still like, there's still a lot of slow movers out there, and there's still some, some kind of recovering that needs to occur from all of this damage. Like if we're just being realistic. David, we can hear you on the YouTube, my man. I think you're muted.
Hello? Okay. Should be fine now. If you take a look at, forget about the macro, if you take a look at the cycles just of Bitcoin by itself, the bearish momentum aligning to on a 4-year basis, halving cycle, should end by end of year, which may actually match something like a Fed pivot. On that, the recovery, meaning, let's say you descend for over a year, and then you take a chop for another year, which is kind of what happened in 2014 and 15. So definitely the cyclicality of Bitcoin allows for that. As we bottom out, as the macro uncertainty clarifies and resolves, as the Fed pivots, and on top of that, as the institutional sentiment recovers on the asset, Bitcoin and crypto as a whole, whatever. So on that basis, goes back to the scenario that Frank gave. We can be below cost basis for, historically the max is about 10 months, could be longer for the first time in history, etc. Also, another thing to point out, Bitcoin CAGR on a 4-year basis, taking again just the simple halving cycle, it dropped for the first time in history this year, after ranging for 6 years between, let's say, on the 130% range or so. It dropped to about the 30% range for the first time this year. So I think you should perceive as Bitcoin increases in terms of float and market cap, a diminishing return valuation, which is completely normal and expected. You know, if you go back to the meme of a S curve that Bitcoin would adopt, I think that's normal conditions within the range. Given the macro environment, going below all-time high extra cyclically for the first time in history is certainly uncharted territory. But still, the range between 16 and 20 could be a major consolidation, which would take the market participants, especially impatient ones, into major punishment. Now, you know, we have major punishment in terms of price. Now we can go into major punishment in terms of time, which is typical for Bitcoin.
Sam, same question to you.
Yeah, those are all great answers. I would just add the way I see hypothetical world, don't know it, where maybe kind of Fed turns around or things changes. I think now it's obviously very political, where everything is focused on inflation for the American consumer. Elections are coming up. No one wants inflation. Fed has announced they can't do anything about food and energy, but they can try to demand destruct through a lot of different avenues. One of those being, you know, pressure on kind of corporate margins, demand destruction through demand for labor as well. So I think probably the next thing to watch, and you mentioned a recession earlier, is kind of a technical outlook of like, are we in a recession or not? Whether we are or not, I think growth is slowing enough to be concerning. The next one, kind of with that technical definition, is kind of the rate of change in unemployment rate, which is a lagging indicator as well. So, you know, in previously larger recessions, if we're kind of comparing this larger economic turning point, which I think we could be in that, it's always hard to tell when you look at something like 08 or 2000s or like 1975. Essentially, you have unemployment rate kind of reaching through those recessions at 7, 8, 9, 10%. So I think that's probably the next thing to give, whether you're looking for a pivot or for a change in policy, enough cause for concern, is that essentially you destruct enough wealth and you kind of try to, you know, decrease the income inequality gap as much as you can. And then kind of the next effects of that are that comes with a rising level of unemployment to follow. So if you're, you know, looking for signs of when that might change, that's probably when employment starts to get high and out of hand and becomes a bigger problem than the inflation destruction, which is probably why the Fed's tightening is so focused on inflation now, hiking rates up so they can kind of turn those over later. Yeah, and I think the duration kind of bear market cycles that David points out, it's interesting that it just kind of aligns a little bit with the economic cycle that we're in today, and pretty similar. So I know you guys put the net unrealized profit ratio or profit loss ratio in your latest report to kind of look at capitulation, and that's also when I just look at like kind of the duration of capitulation of kind of the bear market, of how long people have sat underwater in cycles before. And that can be a pretty sustained duration period. So I think we've got some time through this, as we talked about before you know, this turns over.
Yeah, I think on the Fed, Sam nailed it. I think it's important to remember that the Fed can pivot, and they can pivot quickly. You know, they were planning to raise 50 points in the last meeting. CPI came out hotter than expected, and they raised 75. You know, consider the source. We're equity investors focused on innovation, so we want the Fed to change their tune quickly, but we think that could happen. Hard to say when, but I think you need to see inflation cool down, and then the second major thing they're looking at, kind of as a confirmation of that, being the labor market, seeing them basically, you know, the indicators at least saying they've controlled inflation and the labor market's cooling off. They can kind of declare victory and kind of cool their hawkish tone. What they've been doing now, we would say, is a bit of jawboning, kind of trying to really seem overly hawkish. So once those indicators turn, they can then back off. They basically get the reaction without having to raise as high as they may be indicating right now.
I guess we're all going to have to just sit back and wait as these inflation numbers come in, as the Q2 GDP numbers get reported, to just see sort of how the Fed is going to have to respond to these numbers. They will know it maybe days before we'll know it, but time will tell. David, Frank, I want to give you two the opportunity now to discuss the thread of your guys' most recent report. We've talked a little bit during this segment about the generational buying opportunity that historically has presented itself in this present Bitcoin environment. I want to start first with the very first tweet in that thread about the 200-week moving average. This has been a technical indicator that many traders use for Bitcoin. This, as you can see in the chart for everyone who is joining us on YouTube, we are at a level now that historically has marked a generational buying opportunity. I'm curious for the two of you how you guys in ARK are treating and viewing this moment in time.
I can jump in. Yeah, so one thing to consider, as I mentioned, Bitcoin's CAGR is descending, right, by almost 100 percentage points. So that makes the 200-week moving average as a mean reversion mechanism not as reliable. I would stick more to the on-chain cost basis that we see on the chart here. What you're looking at is pretty much the gray bars is the confluence of price going below the 200-week moving average and the general cost basis of the market or realized price, and the long-term holder, short-term holder cost basis of the market. So pretty much on average, every market participant is at a loss at current time. But given the contagion effects in the crypto market and the macro conditions as a whole, this should be seen, in our opinion, as a wide range of accumulation as the macro uncertainty and the crypto contagion unfolds and resolves. If we want to go into the few other charts, I think Frank can cover the Celsius 3 arrows, and I can cover on-chain.
I want to, before Frank, sorry to cut you off, actually pop over to tweet number 6, the Puell multiple, and have you, David, kind of explain what this is and what this is now showing everyone.
Sure. So Puell multiple, a metric I invented a few years ago. It's simply the miner revenue in USD terms on the day divided by the yearly average, the 365-day moving average of the same miner revenue, USD. It basically measures the earnings compression of miners at any given time, which usually correlates whenever miners in aggregate have a compression of 45%, their yearly average, it usually signals both. It could be a predictor of capitulation by this market cohort, and at the same time engage in undervaluation for Bitcoin as a whole. So right now it activated the 45% signal, and I think it touched 39% or so. But still, another mean reversion mechanism that could still go lower, as we've seen in the chart itself. This is just balancing out what we're seeing in hash ribbons and other metrics specifically related to miners, hash ribbons, miner outflows, and just news events in the ecosystem right now on how just as every cycle, smaller or weaker miners are getting left out of the ecosystem, and new, stronger miners are emerging and capturing that arbitrage.
Thank you for that. I mean, we've been seeing a lot of reports. Dylan and Sam put out a most recent report talking about the miner capitulation. Excuse me. And some miners are selling Core Scientific. You assholes. No longer a shareholder of that stock, but yep. I'm just going to leave it at that, to say the least. Frank, I do want to give you the opportunity to touch on some of the reporting on the counterparty risk. Specifically, I want to go to tweet number 4, where you actually listed some of the 3 Arrow Capital counterparties, and lo and behold, at the top left we see Voyager, at the top right we see BlockFi. Talk to us a little bit about how this web is intertwined and what maybe your expectations are in the coming weeks and months.
Yeah, I mean, this is kind of going back to where we started the conversation, but Suzu and Kyle Davies had a great reputation in the crypto space. They were seen as thought leaders, and they had great performance for a long time. But it looks like they used that reputation to get sweetheart deals and these uncollateralized lending from pretty much everybody in the industry, or at least we're taking loans from everybody in the industry, and that's kind of totally blown up on them. We're learning more every day who is affected. Their margin trading accounts on FTX, Deribit, BitMEX, for example. Genesis and BlockFi have been public about liquidating their collateralized positions, and we know Voyager was a major uncollateralized position. I'm sure there's more that we're going to find out as they go through the bankruptcy process. And you can see just from their portfolio investments, I mean, they were kind of all over the map, from liquid tokens, layer ones, equity of crypto native companies. It really is a massive event. And I think something we've talked about as well is that gives us some confidence is as we kind of learn new findings from this contagion event, each seems to be relatively smaller in magnitude, as in the next shoe to drop seems to be quieter than the last, which gives us a sense that they're kind of winding down in terms of total contagion that could be yet to see. But we're kind of monitoring that closely. I think it's also kind of would love to just discuss this report in general that we're putting out now. This is the second monthly report. This is something that we've been working towards for over a year, as we've kind of built up more and more research knowledge and a team around on-chain analytics, and something that really is unique and possible in crypto that's not possible in the traditional equity markets, given the transparency of the base layer, to be able to put out a report like this that goes down and creates a market commentary that incorporates both on-chain and macro, that is relatable to your crypto investor, savvy or not, and traditional investors as well, hopefully, is what we're targeting. Really taking crypto market commentary to the next level. Something that I'm used to reading quarterly reports for the companies I cover in the equity space, and this is just just a totally different ballgame. So we're super happy to be putting these out now, and love to look forward to engage more community response from it.
Looking forward to those and many more reports. David, Frank, I want to give you the opportunity to make any final or closing remarks.
From my end, I mean, that pretty much sums up what I would have said. But just in general, I think one thing that's also comforting about the crypto space is that, you see players operating around the crypto networks, be it Celsius or 3 Arrows, kind of getting over their skis and blowing up. They've done nothing to harm the fundamentals of the underlying network, and Bitcoin itself is a neutral platform and a neutral technology that everybody can use. Some can misuse it, but it survives. So in the long run, I think the future is bright for this space, despite what we're all seeing today.
Yeah, am I on live stream as well?
Yep, you're good. David, sorry to interrupt you. You're muted on the restream link.
Yeah, that's what I thought. It keeps on muting and muting weirdly. So if you can unmute me, so I can.
I think you're good now. Okay,
perfect. Yeah, so I was just talking about two major lessons for the cycle. One was the major divergence in terms of transparency between Bitcoin and the whole crypto ecosystem and centralized platforms. I think you saw that very much between, the leverage we could find from Celsius and Three Arrows on the DeFi protocols versus their counterparties in centralized lending entities. I think that's the first lesson on how, yes, it may not make things unwind faster, which if you look at it on a long-term basis could be healthier, but it holds up one of the major value propositions of Bitcoin on-chain analysis and to its credit, DeFi as a whole. I think that's a sign of things to come into how proof of reserves and just overall transparency of how markets are dealt with will shift into more transparent mechanisms, meaning decentralized as opposed to centralized. Conversely, the other lesson, which was, I guess, a bit sadder, was the unrelenting correlation between equities and Bitcoin. I think is one of the major tests for the asset as a whole, meaning surviving a deeply hawkish Fed, possibly its most uncertain macro environment and context as a whole. I think surviving that will be major for the asset, especially as investors, institutional or not, start allocating according to actual fundamental value. And this includes equities versus Bitcoin, Bitcoin versus Ethereum or any other cryptocurrency, etc. But still very high conviction in the space as we see how things resolve.
I want to be respectful of both of your time. I know you have another meeting coming up, and say thank you both for coming on and joining us, sharing your work and perspective, and doing the work that you guys do. Thank you both, David and Frank, for joining us. Dylan, Sam, I let you do what you need to do best and tell everyone about BM Pro, the work that you guys are doing. And just as a reminder, their monthly report has been made public for everyone. They went deep down the rabbit hole of contagion. So be sure, if you have not yet already checked out the monthly report, which was made public last Friday, we have pinned it to the top of the spaces. So be sure to pop on over and give that a read. But Dylan, Sam, I let you guys now talk about what you do best.
Yeah, we just kind of, a lot of the stuff we talked about today, we cover in our daily newsletter called Bitcoin Magazine Pro. Cover just really anything that's relating to the Bitcoin market. So macro, the transparency of on-chain data, Bitcoin derivatives, the recent kind of contagion stuff. We like to cover it all. I guess I'll just end, and then I'll hand it off to Sam. But personally, we'll end this with saying that, hopefully at the other side of all this, like this Bitcoin bear market, some lessons are learned in terms of the kind of promises and the illusion of Bitcoin native yield, and actually using what's really a fantastic innovation in a transparent set of property rights, immutable property rights in the Bitcoin network, the Bitcoin blockchain, and using it to actually do what it does best, and that's kind of insulate yourself from counterparty risk. At a retail level, like with using these yield platforms, but also an institutional level, the thing that caught me off guard at first was in terms of like just how severe and quick this bear market was, just admittedly, was the amount of unsecured credit and debt and off balance sheet IOUs in this space. I understood there was a large amount of collateralized debt with high LTV ratios. So relatively safe, but that was always a risk. But the off-balance sheet stuff was something that I didn't expect when you have crypto markets that trade 24/7, 365, where you can over-collateralize to compensate for volatility. So I think, hopefully on the other end of this, lessons are learned. A little bit cynical on that, and I kind of believe that we'll replay a lot of the stuff next cycle at a bigger magnitude. But maybe not as big in relative terms. But that's just, I guess, my 2 cents and sign off.
Yeah, I'll just add to Dylan's point. If you're interested in this content, whether by like audio or writing, sign up for a free subscription at BitcoinMagazinePro.com. Today, we're releasing something on interest rates, commodities, macro environment, charts data. That's all going along with that. But yeah, to Dylan's point, we have a very long-term Bitcoin thesis and view that hasn't really changed and is really based on a lot of the fundamentals that we talked about before. That's kind of separate from where macro's gone over the last 2 years. So check it out. Thanks for having us. Appreciate the time, Q.
Thank you both for joining us. It's been an absolute pleasure as always. If you're not subscribed to Bitcoin Magazine Pro, do it. We're going to cut to a commercial break, and we're going to be joined by Seed Signer to talk about self-custody. So if you are not following along on YouTube, all you Twitter Spaces people, feel free to hop on over, and we're going to be talking a lot about self-custody because with all these contagions, not your keys, not your coins. All right. We'll be back after this commercial break.